Hi everyone. So in this video, I'll be telling more about the course that I teach and also how this would benefit you guys so that you can take an informed decision whether to go for this or you already know this stuff. Okay. So this is my Twitter profile. And as you can see, I'm in this market since 2016. Okay. It's been 7 odd years now. I've been a full-time investor trader since that 2016 and since 2020 when COVID hit, right? That is when this whole teaching thing started because a few of them wanted to learn. And since then, I have mentored almost 800, it's almost 850 as of now. So I've trained all those people and they know how the whole accumulation distribution thing works. Okay. So tell a little about this accumulation distribution. NAC provides a raw data for you. So what I've done is I have a certain set of rules. So if those rules are fulfilled, then it comes in the Excel sheet, and then looking at the Excel sheet, I would be able to kind of understand that okay, here in FMCG, a lot of names are making it to the list, right? So there is something happening in the FMCG segment. So this kind of gives you an idea as to which sector the big guys are targeting. Accumulation is nothing but the inflow of money by the big guys. That is called as accumulation because at the end of the day, it's the big guys who move the market, right? So once you can kind of figure out, okay, these are the sectors where the big guys are buying, it becomes very easy for you to go out there and buy those particular stocks and make money along with the big guys. You can't make money in the market if you're against the big guys, right? So there is 99% chance of you failing when you try to do that. But when you play along with them, there is a good percentage of chance that you make money with them because 99% of the big guys don't end up selling in loss. Okay, so this is the data. I'll be teaching you where to find this data and what are the rules that you would need to apply. And if you're good at Excel or programming, you should be able to prepare this sheet on your own as well. But if you're someone who does not do it, I would still be sending this data sheet for 1 full year so that you build conviction on this particular method and know how the big guys play around which sectors, which stocks they kind of keep buying, keep selling. So I've made a list of almost 700 odd names based on, let's say, these are banks, these are NBFC, housing finance, okay, and then PSU stocks, then mobile software, right? All of that I have made so that we can easily figure out which are the sectors that the big guys are buying, so that we can also go ahead and buy those particular sectors and benefit from it. So once you understand how the accumulation distribution thing works, right? Looking at the data and this particular Excel, then you will be learning the stage-wise analysis. To just to give you a brief as to how this particular accumulation thing works, right? So this tweet was on February 13, 2020. It is there on my Twitter timeline. Also, one can kind of go there and verify it. So accumulation seen in API manufacturers. So if you go there and look at stocks like Solara, JPChem, Indoco, right? Solara gave you 3x, JPChem kind of gave you 5x, and even in the bottom right, I had tweeted about Loris Labs. So Loris was my biggest gainer, almost went up 8x, right? So this data, why I'm showing you this particular tweet is even before the bull run started, there was clear accumulation in the API stocks. Making use of that, I was able to play this pharma trend much before the other retail investors kind of figured it out and tried playing it. Okay, so this is how the data helps you be ahead of what the other retail guys are doing. So you basically play with the big guys. So once you learn accumulation distribution and know when to enter exit, then we'll be learning stage-wise analysis. So stage-wise analysis is when the accumulation happens and when the stock starts moving up. That is stage two is when it starts moving up. Stage three is when the distribution happens, and stage four is when it starts coming down. So once you understand that, there is no point for you to kind of be invested for this whole period up to this point, right? So you save time and you save money as well if you stay out during this particular period, right? Almost from 540 to let's say 410. And not just that, almost for one good year you could have been away from this particular sector, this particular stock, and invested in something that was still in stage 2. So stage-wise analysis also you'll be learning in the course. And then once that is done, you would know, okay, when to buy, when to sell, whether what stage it is. Then we'll be moving on to screener. That is, I'll be explaining you fundamentals, what points do you look for if you want to invest, and then based on that, different screens have made. So if you want to invest in small caps, what are the points you look for? Mid caps, little champ is a portfolio theme that you can make in this screener thing. Then momentum quality. So what is momentum quality? If you want to trade, right? But if you want to trade in only quality stocks, so you can combine both momentum as well as quality and play this. Then turnaround. So what are turnarounds? Stocks that are just turning around and not many people are aware about it. So screener can help you figure out which are the stocks that are having a bump up in sales, bump up in revenues and profits. So you can take the call as and when it declares a result, so that you benefit from the company doing well after that, right? And then if you're someone who's into micro caps, you can go for that, right? So all this you'll be learning. I'll be teaching you how you can create this particular screener and even play around with different values so that you get stocks that you want. Okay. And then coming to cyclicals. So cyclicals is very tricky. Many retail investors lose money. So why people call them cyclicals is they move in cycles, as you can clearly see, up, down, right? So you can't be a long-term investor in this particular stock, because let's look at Tata Steel. It was somewhere like 89 in the year of 2008. Since then, you had to wait almost 13 years to just break even from there, right? So what one should do in cyclicals is you play for that 1.5 year kind of an up move, where the stock would surge and give you a minimum of 100%, right? So minimum is 100% return that these cyclical stocks give you in every uptrend. Okay, in every up move, they end up giving you a minimum of 100% returns in a year's time frame. So if you can identify that, I'll be teaching you when to enter these, when to exit them, based on which you can, because looking at just the PE and all, right, you would end up buying these cyclicals at the top of the cycle and lose a lot of money. So all this you will be learning, and also you'll be added to a Twitter community and Slack group, which is kind of a lifetime membership where other students also discuss their trades, their ideas, and this should help even others kind of pick up and be better at trading or investing. In case if you are interested, then do ping me on Twitter. I will reply to that, and you can take up the recordings or well as the as well as the live sessions. Okay, thank you.